Okay, so when it comes to investing, there is one mistake that has plagued us investors time and time again. I won't make you wait until the end of the video to really get into it either. Let's just jump straight in. So this recurring mistake that many of us investors make is the belief that we can time the market. The idea that you or I can predict if the market is headed up or down. Because in reality, nobody knows where the market is going. Not even the world's best investors, and certainly not someone like me. Now, I know this may sound somewhat confusing if you've been following my previous videos. After all, I've been talking about how I feel like a crash in the stock market must surely be coming at some point soon. I mean, the economy is tanking, billionaires are sitting on piles of cash, and the Fed can only support the market for so long. So in my opinion, yeah, a crash in the next year does look likely. But here's the thing. I've never recommended, nor will I ever recommend, that anybody sell their shares. I've never recommended anyone to exit the stock market or to hold cash on the side in case a crash does come. Instead, I've only ever suggested that from my personal research, and I'm really no expert, but my research says that being well diversified is the key. And that means investing into lots of different things. It means not being 100% invested into stocks. It also means not being 100% out of the stock market, because that's not being diversified either. It means hedging your bets with some non-correlated investments. But what it really means for you is that your money is best protected whatever happens. By being well diversified, you're saying with your actions, I'm prepared for a bull run and I'm prepared for a crash. So as I'm recording this, the market has actually just crashed. But the truth is, the principles in this video are timeless. They are just as relevant today as they will be when you're watching this or 10 years from that date. I kind of struggle to know exactly how to record these videos in a way. Some of you are watching my content for the first time, and some of you have watched several videos before. So in order to not repeat myself for returning viewers, I haven't highlighted as clearly in previous videos as I should have that timing the market does not work. In fact, I'm about to show you some pretty compelling evidence. What I do believe is that diversifying properly means you don't ever have to worry about trying to time the market. You don't have to worry if the market's going up. You don't have to worry if the market's going down. You can just diversify your investments and let them do their own thing. The reason that I've posted several videos recently discussing an upcoming crash is because, well, partly because I genuinely believe it to be true, even if I know logically I can't predict it, but mostly because it's my belief that most retail investors, maybe you watching this video, are invested heavily into the stock market, and that is not a well-diversified portfolio. So I think that highlighting the potential that we could see a crash is effective in making you ask yourself the question, are you really prepared in case a crash comes? Because being nearly entirely invested into the stock market, regardless of how many companies you're invested into, is not the same as being well diversified. So when I talk about the market crashing, I'm suggesting diversification as a means of protecting yourself, not timing the market by selling shares. One video recently discussed specific dates when the federal intervention is likely to run out, but still my conclusion was that trying to time the market is bad, but diversifying is good. This confusion, to be fair, is entirely my fault for not being so clear on this in previous videos, and maybe I should actually start repeating this more often in upcoming videos for new viewers. Let me know what you guys think. So anyway, let's talk about the mistake of market timing. Now, I'll hold my hands up and admit that I've made this error before myself in the cryptocurrency market. I said to people at the time in 2017 that I thought it was a bubble, but that it would keep climbing. I thought I could time the very peak of the market. Well, let's just say I didn't quite get it right. I think we can all understand the appeal, right? But here's the thing. If you miss out on even a few of the best days in the market by trying to time it, you really miss out. We can see here if someone had invested between 1997 and 2020. The bar on the left shows what happened if they remained consistently invested into the stock market. They returned a very impressive 333%. The next bar shows what happened if they missed the 10 best days during these dates. their return dropped by over 200% to a new figure of just 123%. Now, that's if they missed just the best 10 days out of a 23-year window. Just 10 days. Next, we can see what happens if they missed the best 20 days. Their return fell even further to just under 40%. A pretty awful return considering they'd been invested for 23 years and only missed 20 days. The next bar along shows if they missed the top 30 days. Their return fell so much that they actually lost 7% of their money. Let's think about that for a second. If you try to time the market and accidentally miss just a few of the best days, you will have considerably less money than if you just stayed in the market. As the phrase goes, it's about time in the markets, not timing the markets. Now, I know what you're thinking. But if I'm good at timing the markets, I'll get to miss out on the worst days. And if I do that, maybe it doesn't matter if I occasionally miss out on a good day. Fair point. Let's take a look. A study looking into this concept showed that to achieve success, it was more important to correctly forecast bull markets than to correctly forecast bear markets. The study showed that from 1926 to 1983, average returns achieved by predicting just 50% of bull markets underperformed buy and hold strategies, even when bear markets were forecasted with perfect accuracy. In other words, even if you can avoid all of the bad times in the market, you need to also be able to predict a lot of the good times too, because it's actually more important to be in the market for the good times than it is to be out for the bad times. Okay, so we understand that you can't afford to miss the best days in the market, but what if you have a real talent, or if you know someone that does? Maybe you or they can time the market with at least a decent level of accuracy. Well, in another study, researchers looked at target date funds, which are designed to gradually reduce risk as investors age by changing the portfolio's allocation. In other words, as the investor gets older, they want to take less risk, so the portfolio gradually shifts to more bonds and fewer stocks. Here's the thing. When the fund managers see an opportunity to time the market, some will temporarily deviate from the glide path, or the transition to holding more bonds over time. After all, their expertise is why we pay them the big bucks. They're the people who should be able to identify a short-term opportunity to profit. Let's not forget, after all, these are the professionals who have been working full-time in the investment arena for many years. So, what happens? The researchers found that target date funds that deviated from the glide path, in other words, they tried to time the market, underperformed their peers by 0.14% each year. By trying to time the market and seize opportunities, they lost money. As also noted, the underperformance wasn't too severe, but the difference was statistically significant, and it shows that even the professionals lose when they try to time the market. The study also noted that individual investors do a lot worse. According to the 2016 Dalbar Quantitative Analysis of Investor Behavior study, equity mutual investors lost money even while the S&P 500 posted a small gain in 2015. With this in mind, a hypothetical investor with $100,000 would watch their investment grow to $249,000 before tax over 20 years, while that same investor who didn't try to time the market would end up with nearly $483,000, nearly twice as much. As the study notes, the average mutual fund investor has not stayed invested for a long enough period of time to reap the rewards the market can offer the more disciplined investors. And when investors react, they generally make the wrong decision. And here's another thing which these studies don't mention: fees. Now, to be fair, most platforms like Robinhood these days don't actually charge a fee per trade. But there are tax implications if you sell shares, and if you give your money to a fund manager, he or she will certainly charge their fee on top. So you'd essentially be paying someone to try to do something which nearly always loses money. Now, this isn't just a one-off study either. There is heaps of data to prove that fund managers nearly always lose to the market, and they charge their fee on top. In my opinion, it's actually quite a ridiculous system. So we know the time in the market is out, but here's something you probably don't know. This chart shows the annualized returns for the world index since 1970. In other words, how much money you made in the best years or lost in the worst years by investing into the world's stock markets. As we can see, if you invested for just 1 year, you could either gain as much as 56% or lose as much as 30% of your money. If you invested for longer, say 3 years, this range narrowed. This time you could gain as much as 33% or lose 16%. If you invested for 5 years, the range narrowed further, with a potential of 30% gain and a loss of just 5%. But if you invested for 10 years, you could gain as much as 23% and your maximum loss fell incredibly to under 1%. So this goes back to the idea of time in the market being the biggest factor. While, of course, we can't predict the future, history has shown that if you're patient and stay in the market, you'll nearly always come out ahead. But wait, this sounds like I'm contradicting myself, right? I'm making videos about how the stock market could crash and diversifying investments is a good idea. And now I'm saying history shows us that you'll be okay as long as you just stay in the stock market. Sounds kind of confusing, but here's the thing. History has also shown us that most regular people like you and me, do not stay in the stock market. This chart shows us how retail investors tend to react when the market drops. So the light blue line is the American stock market. The grey boxes are the recessions. And the green line is the retail investor participation. Now let's look at what happened after the recession in the early 90s. Retail investors were selling more shares than they were buying for around 5 years. By the time the next recession came around, they weren't as heavily invested as they were at the end of the previous recession, and they'd actually missed out on much of the bull market. Let's look at after the next recession. Between 2002 and 2008, retail investors should have been buying. After all, there was a bull market at the time. But many had been so wounded from the dot-com bubble that they sat on the sidelines and didn't take advantage of the good times. Again, since the 2008-09 recession, retail investors were wounded and weren't investing as heavily as they should have during the subsequent bull run. You see, retail investors often enter recessions so heavily invested into the stock market that they lose a lot of their money. By the time the bull market comes around, they're understandably fed up with the stock market, and so they exit and miss out on the good times. Remember the chart from earlier where we saw that missing even just a handful of the best days ruined your return? Well, this is sadly what happens for retail investors in every one of these cycles. So, what's the solution? Well, you can either be so aware of these cycles that you don't mind losing upwards of 40 or 50% of your money. But I doubt that most people, myself included, could really handle the stress of watching our investments drop by that much. Or you can be well diversified. That way, when everyone around you is losing their minds, you don't lose out so badly. That's the whole point of diversification. And so you find it easier to stay in the stock market for when the good times come back around. So I understand if on the surface this sounds somewhat backwards, but if you actually think about it, if you want to stay in the stock market for as long as possible, which historically is the single best investing strategy around, then it might actually be a good idea to be well diversified, to minimize your pain just for when a crash does come. That way, you won't feel the pressure to sell shares at a later date. Ironically, selling a few shares now to build a diversified portfolio might mean you actually sell fewer shares at a later date. And that really is the key. We all know that the stock market is a game of patience, but the question is, how do you create a strategy which allows you to be patient? Now, I believe the best way of being patient and remaining in the market is being aware that crashes will come, and you, like myself and everyone else, will feel pressure to sell when our investments are dropping. The best way to ease that pressure and to avoid selling is, number one, prepare yourself mentally. Crashes will come, but they have historically always been followed by a bull market in the United States. And number 2, prepare yourself financially through diversification. So in an upcoming video, I'm going to dive deep into several different diversification strategies and give you concrete examples of what some of the best investors in the world would recommend. I'm currently putting together the finishing touches on my research at the moment. I'm hoping to have that video out on Wednesday. So if you're watching this after Wednesday, it should hopefully be up here now. If not, in the meantime, check out a few other videos I've put together, which is up here as well, on how the billionaires of this world are investing their money right now and how we can learn from that. Thank you for watching.